And as a matter of fact, this actually happened to my father. My father had a business. He went into a partnership with some guy. My dad was the sales guy. He sold anything. He could sell an idol in the middle of an ocean to anybody. He was a great salesman. And I had the other guy had the merchandise, but he couldn't sell anything. So they formed a partnership and distributed their earnings properly. Eventually, my dad was a very frugal guy. My dad did not spend anything. He didn't buy anything he really didn't need. The other guy, on the other hand, was very easygoing. He went to Las Vegas, he gambled, etc. Years after that, the spouses start to get in, and the spouse of the other guy said, "How come Mr. Rivas lives so well that we live in this dump? He's probably stealing from you," and da 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 da. So eventually, the partnership goes south. They break. Each one goes their own way. But without a partnership agreement, then you pretty much leave it up like in a marriage. That's what I mentioned in marriage. When a marriage goes south, it's a fight. And the people that makes the most money are attorneys. Nothing against the attorneys. We need them. But when you have a partnership agreement that clearly identifies your responsibilities, your shares, your income, what you're going to take, etc., it just makes everything a lot easier and easy to flow. What do we need? We need to, each partnership is an entity of its own. That means that it will require its own AIN number or employee identification number issued by the Internal Revenue Service. And in instructions, when we go through them, you'll see how to obtain one of those, when you form one. You're reporting from partners the total income of a business. Now, it is not subject to income taxes, like I mentioned before. You can have unlimited number of partners, and you report everything on the balance sheet, assets, liability, and equity. Everything must tie. You can have the assets equals liability plus equity. That's usually the balance sheet. Let me see here. Reporting from the form to partners is the K1. The K1 gives them exactly what their share of their profits or losses, for that matter, because if you ended up with a loss, they share the loss as well, and that loss transfers to the 1040, reducing their income. In determining the percentage of ownership, it's done by contributions. What I mean is that if I contribute, let's say that the opening balance on a corporation is $10,000, and I contributed $1,000, my brother contributes $4,000, and somebody else $5,000. Well, my share of the business is only 10%, based on my original contribution. Even if I do the work, and when it comes to capital, my contribution is only 10%, and that is what is reported to me. So at the end, I have the right to 10% of the earnings of losses. And it reports all kinds of income,